Welcome to this week's market drama. We'll start with the S&P 500, which is up 0.7% for the week. It is now up 18% for the year. Oil had a strong week as well, rebounded more than 2%. It is now only down 4% for the year. When it comes to the stock market, we really have seen a pretty strong rally off the October bear market lows. We've recouped majority of the 26% decline that we saw between January of last year and October of last year. A big component here, as we'll discuss, is inflation, but also earnings matter, right? In fact, earnings season is underway. 18% of the S&P 500 has reported. Number of positive earnings surprises in line with recent averages. If we hit the consensus expectation here, we should see a 9% drop in year-over-year earnings for the S&P 500. It would mark the largest earnings decline reported by the index since Q2 of 2020. It would also mark the third straight quarter in which the index has reported a decrease in earnings. But a lot of this is already baked in, right? That's why the markets are still, rallying. This was expected, right? In essence, we were expecting pretty rough earnings right now. For all of the 2023 year, analysts are predicting earnings growth of 0.1, essentially flat. But we are starting to see upwards revisions for the outer quarters for next year, as kind of call it the hard landing for the economy hasn't played out. So when it comes to the economy, last week we saw retail sales up 0.2% month over month. That's below the 0.5% expectations. Retail sales matter a lot because consumption is 69% of GDP, right? So 0.2% not as good, but it's still in positive territory. The consumer has actually been really resilient considering how interest rates have gone up so much over the last year and a half. So the other component of economic data that came out is housing starts fell to 1.4 million from 1.56 million the prior month. This 1.434 was below expectations. Housing really, if anything, has been the area that you would expect to be hit the hardest when interest rates go up. So this is not necessarily something that we shouldn't expect, right? Housing to cool off. If anything, it was one of the first sectors to cool off and is starting to stabilize. Initial jobless claims came in at 228, which was better than the 240 expected. Having said that, the 3-week moving average, right, because we get initial jobless claims every week, the 3-week moving average is up nearly 20% over the last 6 months, right? Higher initial jobless claims is not a good number, right? It means that there's more people looking for jobs, that they don't have a job. So this is a number that is a leading indicator, and it does show that the job market is starting to cool off, right? From very strong levels, very tight levels, it is starting to cool off. This week, the big news, the FOMC meeting happens on Tuesday and Wednesday. On Wednesday, the Fed is expected to hike rates 25 basis points, but they're supposed to kind of pause after that. As always, the key here will be, what do they say after they hike the 25 basis points? What's the messaging that they'll have going forward? The other big highlight to keep an eye on is PCE inflation data comes out this week. This is a measure that the Fed watches very carefully, so we're going to watch it as well. That's it for this week. Stay tuned for next week.